Everything about this decision looks wrong. One of the richest men alive owns enough stock to pay off billions of dollars in personal debt in a single afternoon. He could log in, sell a small slice of what he owns, clear every loan attached to his name, and never think about it again. Instead, he keeps the debt. He keeps paying interest on it, year after year, while the stock just sits there. If you brought this plan to a personal finance class, the teacher would stop the lesson. If you brought it to a bank as a loan officer, they'd ask you to explain it twice. And yet this isn't a mistake. It isn't an accident, and it isn't something his accountants are quietly trying to fix. It's deliberate. It's a strategy. And once you understand why, you'll never look at rich people debt the same way again. Before we open this file any further, hit like, drop a comment with your first guess as to why someone would choose billions in debt over an easy sale, and subscribe with notifications on so you don't miss how this one unfolds. So here's the actual mystery. The man in question is Elon Musk, and the company is Tesla. Over the years, Musk has pledged enormous blocks of his Tesla shares as collateral for personal loans, tens of billions of dollars worth at various points, instead of simply selling stock to raise cash. Selling would be simple. One transaction, funds in the bank, debt problem solved. Borrowing is messier. It means owing money to banks, watching interest pile up, and accepting real risk if the stock ever drops hard. So why take the harder, riskier, more expensive-looking path? Why would the world's richest man treat sell some stock like it's off the table? James stares at the number on the screen. A loan balance in the billions, sitting quietly next to a stock portfolio worth many times more, and does the thing he always does. He tilts his head. "Wait," he mutters, tapping the glass of his magnifying glass against his palm. "If I owed money and had the exact thing I needed to pay it off sitting right there, I'd just pay it off. Why wouldn't he?" He opens the yellow folder. Today's business file has officially started. To understand this, you have to understand what Musk's wealth actually is, and more importantly, what it isn't. Musk is regularly ranked among the richest people on the planet, but almost none of that wealth exists as cash sitting in a bank account. It exists as shares of Tesla stock, plus stakes in his other companies like SpaceX. On paper, that's an enormous fortune. In practice, it's more like owning a spectacular house that keeps appreciating in value. You're worth a lot, but you can't hand a grocery store clerk a fraction of your living room. For most of his time running Tesla, Musk barely touched that fortune. Public records show he sold Tesla shares only twice before 2021, once in 2010 and once in 2016, and Tesla's stock climbed an almost unbelievable amount in the years between that last sale and his next one. Picture buying a lottery ticket, tucking it in a drawer, and forgetting about it while the jackpot quietly grows for a decade. That's roughly the position Musk was sitting in. Enormous wealth, almost no cash, and a very specific problem. Eventually, real life sends you a bill that stock certificates can't directly pay. There's another wrinkle most people never think about, and it makes the mystery even stranger. When a CEO who's also a major shareholder sells stock, it isn't a private matter. U.S. securities rules require those trades to be publicly reported, usually within days. So it's not like Musk could quietly sell a few $1 billion of Tesla and slip the transaction past everyone. Every sale shows up in public filings, gets picked apart by financial media, and gets read by investors as a signal about what the insider thinks is coming next. Imagine if every time you moved money out of your savings account, your neighbors got a text message about it and started asking questions. That's roughly the spotlight Musk would be selling into. So already, before we even get to the money itself, just sell some stock carries a cost that has nothing to do with dollars at all. It's a cost measured in headlines, speculation, and market nerves. That problem became impossible to ignore in 2022, when Musk agreed to buy Twitter for $44 billion. Suddenly, the man with more wealth than almost anyone on Earth needed actual spendable money, a staggering amount of it, fast. And this is where the mystery deepens instead of resolving, because the obvious solution, just sell Tesla stock, turned out to be the one thing Musk seemed to want to avoid as much as possible. Quick reminder before we go further, if this is already messing with how you think about being rich, smash that like button and share this with someone who thinks having money and having cash are the same thing. Trust me, they're about to learn they're not. Here's the first real clue. When you sell stock, two things happen at once, and both of them work against you. First, the tax bill. In the US, selling appreciated stock triggers capital gains tax, a real immediate cut owed to the government on the profit, whether or not you actually wanted the cash right that second. Second, and just as important, selling sends a signal. When the CEO and largest shareholder of a company starts dumping huge chunks of stock, other investors notice, and they often start selling too, out of fear that the person who knows the company best is losing confidence in it. We actually saw this play out in real time when Musk did eventually sell tens of billions of dollars of Tesla stock to help fund the Twitter deal. The stock price fell sharply in the following months, partly because of exactly this dynamic. Selling, in other words, isn't free. It costs you in taxes, and it can cost you in stock price too. So if selling is expensive in two different ways, what's the alternative? This is where James leans in close to the folder, because the next clue is the one that actually cracks the case open, and it's a trick that isn't unique to Musk at all. It turns out there's a completely legal financial move that wealthy people with large stock portfolios use constantly, and it works almost exactly like something far more familiar, a home equity loan. If you own a house that's gone up in value, a bank will often lend you money using the house itself as collateral. You don't sell the house, you just borrow against what it's worth, and you pay the loan back over time. Stock can work the same way. Instead of selling shares, you pledge them to a bank as collateral, and the bank hands you cash. You still own the stock. You still benefit if it keeps rising. And critically, this is the part that made James's eyebrow shoot straight up. Money you borrow isn't income, so it isn't taxed the way a stock sale is. Musk used exactly this move, at times pledging tens of billions of dollars in Tesla shares to unlock loans worth a fraction of that value, including a plan for a roughly $12.5 billion loan backed by $62.5 billion in pledged stock during the Twitter deal. Borrow instead of sell, and on paper, you dodge both problems at once. No big tax bill, and no giant stock sale spooking the market. James actually laughs out loud at this part, because he immediately pictures himself trying it. So I could walk into a bank, point at my one modest investment account, and say, "Lend me a stack of cash, I'll just leave this here as a promise." He imagines the loan officer's face. It's not a yes face. Turns out the size of the portfolio changes everything. Banks aren't lending against the idea of wealth, they're lending against Tesla stock specifically, which happens to be liquid, publicly traded, and easy to value to the penny every single day. Try that pitch with a modest 401k and a loyalty card collection, and you'll get a very different meeting. But hold on, because if this trick were completely free, every wealthy person would max it out without a second thought, and banks would be lending against stock with no limits at all. That's not what happens, and that gap is exactly where the real strategy and the real risk lives. Here's the hidden strategy underneath all of it, and it has a name most people have never heard. Financial planners sometimes call it buy, borrow, die. You buy assets that grow in value over time. You borrow against them instead of selling, funding your lifestyle with loans instead of income, so you're never handing a chunk of it to the IRS along the way. And eventually, this is the quietly wild part, if those assets are passed on after your death rather than sold during your lifetime, the tax rules treat their value as reset to whatever they're worth at that point, which can wipe out decades of built-up gains for tax purposes entirely. Musk isn't the only high-profile example either. Oracle co-founder Larry Ellison has used a similar approach for years, pledging tens of billions of dollars of his own company's stock as loan collateral rather than drawing a large taxable salary. This isn't some obscure loophole discovered by accident. It's a well-known playbook, and it explains, clue by clue, exactly why just sell the stock was never really the plan. Quick gut check, because I promise this pays off. Would you rather owe a bank money on a loan you control, or owe the government money on a sale you can't take back? Hold that thought, because there's one more piece of this puzzle, and it's the part that makes the whole strategy far riskier than it first appears. If you like where this file is heading, drop a comment telling me whether you'd ever borrow against your own investments instead of selling them. And don't forget to subscribe so you catch every business mystery we open. So here's the reveal. The moment where every clue we've stacked up finally clicks into place. Borrowing against stock only works smoothly as long as the stock stays valuable enough to cover the loan. Lenders don't hand out unlimited credit against pledged shares. Tesla's own board, for instance, put a formal limit in place back in 2018, capping how much company officers could borrow against pledged stock relative to its value, precisely because an unchecked pile of borrowed money sitting on top of a single stock is dangerous. If the stock price drops far enough, the loan suddenly looks too large compared to what's backing it, and the lender can issue what's called a margin call, a demand for more cash or more collateral, immediately, or they force a sale of the shares themselves to cover the difference. That's exactly what nearly happened during the Twitter saga. As Tesla's stock slid in 2022, Musk's original plan to borrow billions against pledged shares became shakier, and he ultimately shifted much of the funding towards selling stock and raising money from outside investors instead, because the original borrowing plan had gotten too risky to lean on as heavily as intended. The aha here is this. Borrowing instead of selling isn't a way of avoiding risk. It's a way of trading one risk, a tax bill you know in advance, for a different, sharper risk, a bet that the stock will stay high enough, for long enough, that the debt never becomes a trap. Musk didn't avoid risk by borrowing. He relocated it. And that's the real business lesson hiding inside this whole file. Debt, used carefully, isn't automatically reckless. Sometimes it's simply cheaper than the alternative, the same way it can make sense for a family to finance a home instead of saving up decades of rent money first. But debt backed by something that can lose value fast is a different animal entirely. It rewards you handsomely when things go well, and it can turn on you violently when they don't. Which is exactly why the wealthiest people using this strategy still build in limits, cushions, and backup plans, rather than borrowing right up to the edge of what their stock is worth. The lesson isn't borrowing is smart or borrowing is reckless. It's that leverage is a tool that amplifies whatever direction things are already moving, and the people who use it best are the ones who never forget that it cuts both ways. It's a little like a family that looks completely comfortable from the outside. Nice house, nice car, nice vacations, while quietly juggling a mortgage, a car loan, and a credit card balance behind the scenes. None of that makes them reckless or foolish. It just means looking wealthy and having cash on hand are two entirely different things, at every income level. From a family budgeting around a car payment to a billionaire juggling loans against a stock portfolio. The scale changes, the basic tension doesn't. Take a second and think about that the next time you hear that a billionaire is worth some enormous number. That number almost never means cash sitting in a vault somewhere. It usually means stock, a bet still in motion, still capable of rising or falling, still one bad month away from turning a clever strategy into a very expensive problem. Musk's fortune isn't a pile of money he's sitting on. It's a pile of risk he's actively managing every single day, whether the headlines mention it or not. That's not a flaw in the system. It's just what rich actually looks like once you open the file and read the fine print. Business lesson closed. Before you go, tell me in the comments, knowing what you know now, would you rather owe the bank or owe the tax office? Like this video if your brain just did a full loop. Share it with the one friend who still thinks billionaires keep their money in a giant vault, and hit subscribe with notifications on. Because next week, James is opening a file on something you've probably swiped through 100 times without a second thought. Why airlines make more money from the credit card in your wallet than from the plane ticket you just bought. That one's going to change the way you look at your boarding pass forever. See you in the next file.